Yeah, so Carmen Holdings is the name of this company. It's an interesting name that actually just started trading publicly. So they're in the space and defense space. They design and manufacture mission critical aerospace systems serving the defense and space sectors with propulsion payload and aerodynamic technologies. So they just started trading. They just did their IPO in February of this year, actually, February 25th. IPO price of $22, currently trading today at $32. And it is a $4.3 billion market cap company. So very new entrant on the market, not much track record. What they call themselves, they're a leading IP-driven supplier to contractors in three high priority end markets. So this includes hypersonics and strategic missile defense, like propulsion systems, tactical missile and integrated defense systems, and also space and launch, like payload protection and deployment systems. So they're fairly diversified amongst those three end markets, and they are present in a wide range, over 100 different funded space programs. So they have clients including Starlink, U.S. government, and essentially most of the main players. Now, when we look at the company's 2024 financial results, good positive results. Of course, these were not reported with them as a public company. Essentially, 23% growth in revenue, strong improvement in gross margin, 31% growth in operating income, and about 30% growth in adjusted EBITDA. We don't have any per share figures here because they weren't public at the time. But if you look at the historic performance that they're reporting going back to 2022, you can see a fairly good track record of growth over a couple of years here. 24% compound growth in revenue and 33% in adjusted EBITDA. And then looking forward to 2025, in terms of guidance, they're expecting about 24% growth in revenue at their midpoint and 27% growth in adjusted EBITDA. Now, in terms of just the overall growth, very impressive what they're able to produce here. But we really haven't had a chance to see this company produce on a per share basis as a public company. What we can do is look at analyst earnings estimates. So for the current year, 38 cents at the midpoint. That's almost a 90 times price to earnings valuation. And then going into next year, they're expected to generate at the midpoint of analyst estimates, 47% EPS growth, bringing them to 56 cents per share, still about a 60 times earnings multiple. Another thing that is somewhat concerning when I look at the company is just the balance sheet. I wouldn't say that they're over leveraged at this point, but they are fully leveraged. They have total debt and leases of about $450 million, about $4 million in cash. And then if we were to go off of their guidance for the current year, that would be a net debt to EBITDA multiple of 3.2 times. So normally we would like to see this number below 3, ideally below 2. So where it's at right now is more or less pushing the boundary of what we would consider to be appropriate leverage, but not a lot of flexibility to increase it from here. So when I'm looking at this company, it's a very interesting business. The areas that it's in right now are exciting, and there's certainly a lot of growth opportunity in both those spaces. Space, obviously, is a huge growth opportunity longer term. Defense, a lot of money going into this space now, just given the geopolitics of the situation. So it's unique in the fact that it's a smaller cap company, high growth, profitable in these areas. So we like that. The balance sheet, we would like to see less leverage on the balance sheet. It does have a lack of track record in the public markets, given that it just started trading in February. And we would consider the valuation be expensive, even based on next year's expected earnings. It's about 60 times, a 60-time multiple. So while we think it's an interesting company with good fundamentals overall, our conclusion is that we wouldn't be buyers of it right now, mostly due to valuation and just the lack of track record. But it's something that we'd monitor. And if we did have an opportunity to enter at a more attractive price, then we'd consider doing it.
Yeah, I would just say it looks expensive right now, especially fully leveraged, going forward. So even if we're looking on a forward basis, it looks expensive. If it keeps growing.
Yeah, I mean, if we were looking at this and it was a net cash situation, giving it a lot of flexibility to.
But yeah, and I wouldn't be surprised if that the debt level was why they IPO'd partially, at least, because they did reduce their leverage. They raised 173 million, so that would have reduced their leverage a bit. And yeah, they refinanced their credit facility as well. So they're obviously looking towards the balance sheet when it comes to that sort of stuff. It's not the greatest position, and not surprising that they need to raise money in some sort of way, and they probably just saw the IPO as opportune timing.
No, I mean, if they were sitting there with more resources on the balance sheet, then that growth, if there were opportunities for a step change in growth, like a big acquisition or a big contract, we'd have more confidence that they'd be able to pursue it then without having to resort to debt or share issues. But although issuing shares right now might not be a bad idea if they're getting almost 90 times earnings for them.